Welcome to the Research Desk. We are looking back at the architecture of the American credit card industry in the late 1980s. Picture an absolute behemoth of a market, generating just staggering revenues, yet operating almost entirely blind.
Blind is almost an understatement. They were basically flying a jumbo jet with a compass and a crayer.
Exactly. This was an industry pricing millions of unique customers by convention. They used incredibly broad demographic categories and, quite frankly, gut instinct. The financial institutions of that era were sitting on a gold mine of unutilized behavioral data, yet they operated as if the mathematical complexity of consumer risk was simply, too great to measure precisely.
Which brings us to the central mystery we are unpacking today. It is fundamental to understanding modern finance. Was banking in the late 20th century ever genuinely a lending business? Or was it always an information business that simply hid behind interest rates, plastic cards, and legacy assumptions?
And my position is that Capital One answered this question definitively. They revolutionized the fundamental mechanics of the business model by turning the credit card into a continuous laboratory. They built an invincible flywheel of experimental routines and financial arbitrage that permanently altered consumer finance. They proved the industry was pricing by habit.
Well, I have to step in there. While Capital One's initial information arbitrage was undeniably brilliant, their story is ultimately a profound lesson in the fragility of an analytical edge. We are looking at a burning fuse here. The narrative of an invincible flywheel is highly seductive, sure, but the historical reality is that once the rest of the industry learned basic statistics, the mathematical advantage inevitably compressed.
Compressed, maybe, but not destroyed.
But it proves that data advantages are historically transient. The moment you prove that measurement works, you literally force the entire market to evolve and imitate. But before we get to the compression of their advantage, we really must examine the environment that allowed them to build it. If the data to do better already existed, why did an entire industry of sophisticated, well-capitalized institutions choose to remain intellectually lazy?
To understand that intellectual laziness, we have to look closely at the artisanal operating logic of the legacy credit card market in the 1980s. They possessed credit scoring, of course. They were certainly not ignorant of the concept of risk.
Right, they had FICO, they had bureaus.
They did, but their operational framework treated millions of unique consumers as if they were drawn from just a handful of incredibly blunt buckets. You had your prime customers, you had your non-prime customers, you had revolvers who carried a balance, and transactors who paid their bills in full. And that was pretty much the extent of the granularity.
Maybe a crude demographic overlay based on a zip code or a self-reported income bracket on a paper application. But fundamentally, the product itself was completely static.
Exactly. They offered one annual percentage rate, usually around 19.8%, for millions of customers. They established one monolithic credit line policy for massive swaths of the population. They would mail identical direct mail packages to entire cities. Think about the mechanical implications of that.
It is a massive misallocation of pricing.
It is. Imagine a 35-year-old teacher who has never missed a payment in her life, and a 22-year-old with a history of erratic employment and late fees. Because they lived in the same geographic region and cleared a basic rudimentary credit threshold, the bank mailed them the exact same piece of plastic with the exact same interest rate. The bank was effectively taxing the highly reliable teacher to subsidize the inevitable defaults of the 22-year-old.
Which creates massive financial distortions.
Huge distortions. The banks were simultaneously overcharging highly profitable borrowers because they simply could not distinguish the truly exceptional customer from the merely acceptable one. They lacked the mathematical tooling to price for individual excellence.
Concurrently, they were massively mispricing riskier customers. They had absolutely no rigorous way to model how a consumer's behavior would change under different economic terms. They did not know if a lower teaser rate would attract a highly profitable customer looking to transfer a large, stable balance, or if it would merely attract desperate rate surfers who would vanish the moment the promotional period ended.
Operating completely in the dark, using portfolio-level pricing instead of individual-level pricing.
But see, calling the entire banking industry of the 1980s intellectually lazy fundamentally misdiagnoses the nature of their blind spot. It is like criticizing a 19th century doctor for not using a microscope to diagnose a bacterial infection.
You think it was just a lack of tools?
It was a failure of tooling, not a failure of imagination. The blind spot was not a simple refusal to look at data. The blind spot was the inability to view the data itself as the actual product. You mentioned the identical direct mail packages sent to entire cities. In that era, direct mail was treated exclusively as a megaphone for mass broadcasting. It was a one-way advertising channel designed to push a fixed commodity into the market.
Rather than a microscope for observation.
Exactly. It was not viewed as a microscope for behavioral observation. The banks had data, certainly. They had massive mainframe computers processing millions of transactions every night. But they lacked a disciplined, structural system for turning that raw exhaust into continuous product experimentation. When executives made credit decisions based on intuition, relying on their tummy, as the historical phrasing goes, it was because probability distributions were not yet computationally embedded into their workflow.
Because the data was entirely siloed.
Completely isolated. The marketing department owned the mailing lists. The credit department owned the risk scores. The operations department owned the transaction processing. The technological architecture to connect a specific mailed offer down to the exact interest rate and envelope color to a specific behavioral outcome 5 years later, and then feed that precise outcome back into the next underwriting decision, it simply had not been built.
Relational databases capable of that kind of multi-dimensional query were just barely becoming commercially viable.
So the incumbents were not lazy. They were trapped in the operational physics of their own era.
Well, if it were purely a lack of tooling, the incumbents themselves would have eventually recognized the gap, purchased the new relational databases, and built the tools internally. Instead, it took the introduction of complete outsiders to ask the fundamental questions that dismantled the industry's operating logic. Enter Richard Fairbank and Nigel Morris.
Coming from the strategic consulting world.
Right, which gave them the ultimate outsider advantage. They were not career bankers burdened by decades of institutional dogma. They interrogated the core assumptions that the legacy institutions had stopped questioning years prior. They looked at the landscape of 19.8% annual percentage rates and asked why everyone was charging exactly the same price for risk.
And why the physical mailers and the financial offers were so profoundly undifferentiated.
Most importantly, they asked why risk was being treated as a permanent, static label rather than a dynamic signal. They recognized a structural flaw in how credit was conceptualized. The value of a credit card business was not actually in issuing the debt or collecting the interest.
It was the information.
The true value was in learning as rapidly as possible which specific combinations of pricing, risk parameters, incentives, and messaging produce the highest expected lifetime value for highly specific micro-segments of consumer behavior. They saw that the industry was banking with static spreadsheets when it should have been banking with dynamic probability distributions. They conceptualized the credit card not as a loan, but as an information-gathering mechanism.
But recognizing a paradigm shift from a consulting desk and successfully executing it inside a highly regulated financial market are two entirely different things. Seeing a blind spot in the market is an intellectual exercise. Building a corporate structure capable of structurally exploiting that blind spot is an operational miracle.
It absolutely required a very specific laboratory to incubate.
Right. To truly understand how this theoretical critique of legacy banking became an existential threat to the industry, we have to look very closely at the protected laboratory where this hypothesis was actually tested. The theory alone was utterly useless without a banking charter to incubate it. You cannot simply write software and pretend to be a bank.
Not in the 1980s anyway, read in detail, because it is the foundational bedrock of the modern data-driven enterprise. The founding doctrine that Fairbank and Morris developed was called information-based strategy, or IBS.
Sounds like standard consulting jargon.
It does, but the underlying mechanical implications were completely radical for consumer finance in the late 1980s. IBS dictated that financial products should no longer be treated as fixed commodities sold to broad demographic markets. Instead, a credit card must be viewed as a highly configurable, infinitely variable offer.
Meaning every single parameter of the product is fluid?
Every single one. The annual percentage rate, the credit limit, the promotional fee structure, the balance transfer window, the annual fee, the rewards program, even the customer service routing, and the specific marketing language printed on the envelope.
All of it could and should be varied systematically based on precise, empirical measurement.
So the credit card issuer's primary role was no longer just lending money and collecting interest?
No. The issuer's primary role was running massive, mathematically controlled experiments on human profitability. They realized that if you have 10 different variables on a credit card and 10 possible options for each variable, you do not have one product, you have a combinatorial matrix of 10 billion possible products. The goal was to build a database capable of mapping those 10 billion permutations to individual consumer profiles to find the exact configuration that maximized expected value.
Biggest names in finance, and they were shown the door.
Which is incredible in hindsight.
I want to dwell on that rejection because it highlights the profound paradox of incumbent advantage. The massive legacy banks possessed the capital, the customer bases, the brand equity, and the regulatory infrastructure to implement IBS immediately. They could have hired the engineers. They could have bought the database servers.
But they didn't.
Because they were entirely too comfortable to fundamentally rebuild their core systems. Their existing models, crude and mathematically blunt as they were, generated massive, reliable profits. Reorienting an entire financial institution around continuous statistical testing requires dismantling existing hierarchies.
It means telling the senior guys they don't get to make the calls anymore.
Exactly. It means taking power away from the senior credit officers who have spent 30 years making lending decisions and handing that power over to 25-year-old statisticians writing database queries. No incumbent executive is going to willingly detonate their own organizational chart just because a consultant shows them a theoretical mathematical matrix.
Which is why Signet Bank is so crucial to this story.
It is vital to emphasize the importance of Signet Bank, a regional player in Richmond, Virginia, stepping forward and saying yes to Fairbank and Morris in 1988. We are so conditioned by modern technology narratives to expect disruption to originate in a Silicon Valley garage with venture capital funding. But this was a corporate insurgency.
You need real money to originate real loans.
To execute information-based strategy in consumer finance, you must originate real loans. Signet Bank provided the protected corporate environment, the requisite balance sheet, and the critical regulatory cover necessary for this experiment to survive its infancy. They were a regional bank desperate enough for growth to take a chance on a profoundly weird idea.
And that 5-year laboratory period inside Signet, spending from 1988 to 1994, is the absolute crucible of this story. This is where the actual mechanical architecture of the modern analytical company was forged. They were not merely tweaking marketing copy or changing the color of an envelope. They were building an entirely new operational architecture from the ground up.
Integrating data sets that legacy banks kept completely separate.
Which was incredibly difficult back then. In 1988, integrating data meant physically moving magnetic tapes from one mainframe system to another. They merged massive credit bureau files with internal account behavioral data, cross-referenced that merged file with direct mail response metrics, and tied all of it to long-term profitability outcomes over a multi-year horizon.
Moving beyond just default risk.
Way beyond. They built predictive models not just for default risk, which was the standard, singular focus of legacy banking, but for lifetime expected value. They modeled attrition risk. They modeled revenue generation. They modeled the precise elasticity of demand regarding interest rates. And perhaps most importantly, they engineered a profound cultural shift.
The culture of the test result over the executive.
Yes. They built an operational environment where a statistically significant test result completely unequivocally overruled the opinion of a senior executive. In legacy banking, the hierarchy dictated the product. The senior vice president decided what the interest rate would be. Inside this laboratory at Signet, the algorithm dictated the product. The data decided the interest rate.
And that culminated in the 1991 breakthrough.
By 1991, they achieved a massive operational breakthrough with a highly targeted balance transfer direct mail campaign. By structuring the offer differently, offering a low teaser rate specifically designed to incentivize consumers carrying high-interest debt on competing cards to move that debt over to Signet, they demonstrated how dramatically the specific, granular configuration of a credit product could influence the underlying economics of customer acquisition.
They proved empirically that a financial product was entirely elastic to its presentation and its terms.
They proved that consumers were not monolithic.
They were highly rational economic actors responding to precise structural incentives.
But I have to ask, were they truly inventing a profoundly new type of banking? Or were they simply the very first actors to effectively apply direct marketing mathematics to a financial product?
That is a fair distinction to explore.
Because the catalog industry and the broader direct response marketing world had been utilizing precise A/B testing, granular response tracking, and complex expected value calculations for years before Fairbank and Morris arrived at Signet. The people selling mail-order apparel or magazine subscriptions knew exactly how much a change in envelope color or a shift in the promotional offer or a specific demographic mailing list impacted final conversion rates. They had mastered the logistics of mass-customized mailing.
True, but applying it to a credit vehicle is vastly more complex than selling a sweater.
I agree it is more complex, but I strongly challenge the notion that this 5-year incubation was a stroke of absolute unprecedented financial genius. It seems far more likely, structurally speaking, that this was simply the required technological gestation period for an industry that severely lacked the infrastructure to process its own behavioral exhaust.
Because the data warehouse didn't exist yet.
Exactly. They had to spend 5 years building the data warehouse because a data warehouse linking marketing to underwriting simply did not exist in consumer credit. But the mathematical principles of direct marketing, the fractional factorial design, the holdout groups, the response curves, were already well established outside of finance. They imported a discipline. They did not necessarily invent a new form of math.
Even if the mathematical foundation originated in direct marketing, the aggressive application of those principles fundamentally altered the financial physics of the banking model itself. When Signet spun off this experimental division in 1994's Oakstone Financial, which was rapidly rebranded as Capital One, they did not spin off a direct marketing agency.
No, they spun off a bank.
They spun off a massive hypothesis engine completely disguised as a traditional consumer bank. The mechanical beauty of Capital One's business model is that it only looked like a lending institution from the outside. It issued cards, it collected payments, it reported to the credit bureaus, but on the inside it operated as a perpetual, incredibly aggressive experimentation loop driven by 5 highly specific interlocking gears.
Let's walk through those gears because the scale is where this gets fascinating.
I want to break down exactly how this machine operated because the structural physics of this flywheel are extraordinary. Gear 1 was the sheer volume of statistical testing. We are not talking about running a dozen focus groups to decide between a blue card and a green card. We are talking about running 80,000 separate mathematically controlled experiments every single year.
80,000. That is an absurd volume for the 1990s.
It is. These tests systematically varied every conceivable lever of the product. They tested the introductory teaser rate. They tested the duration of that teaser rate. They tested the balance transfer fee. They tested the permanent credit line assignment. They tested the annual fee structure. They tested the specific reward accumulation rate.
Even the physical creative design.
They tested the physical creative design of the mailer, the exact wording of the call to action, and the highly specific target prospect list pulled from the credit bureaus. Where the legacy competitors looked at the landscape and saw one monolithic market demanding a 19.8% APR, Capital One looked at the exact same landscape and saw thousands upon thousands of distinct submarkets hiding within the data, each requiring a bespoke product configuration.
The scale of the testing is certainly critical, but creating 80,000 permutations only matters if it leads to fundamentally superior operational action. The thousands of submarkets generated the necessary statistical inputs for what we must recognize as a massive, continuous computational sorting mechanism. Generating the data is the prerequisite, exploiting the data is the business model.
Which brings us directly to Gear 2. Finer segmentation allows for pricing precision that appears entirely irrational to legacy competitors. In the legacy system, if a customer had a mediocre traditional credit score, perhaps a FICO score of 600 due to a minor medical delinquency 5 years prior, they were automatically dumped into the subprime bucket and offered a punitively high interest rate. End of story.
Because the legacy bank saw only the aggregate score.
Exactly. But when you apply finer segmentation powered by massive testing data, that same superficially risky customer might actually become highly attractive. If the Capital One model analyzes their specific response behavior to previous mailers, their highly granular spending profile, the exact depth and trajectory of their credit bureau file, their expected tenure with the product, and their mathematical sensitivity to promotional balance transfer offers, the comprehensive picture changes entirely.
allowing Capital One to offer terms that seemed economically suicidal to traditional banks.
Right. The competitors would see Capital One offering a prime interest rate to a consumer with a 600 FICO score. And the competitors thought Capital One was simply buying market share by taking on terrible, unpriced risk. They assumed Capital One was marching toward insolvency. What the competitors did not understand was that Capital One was not pricing based on the static FICO score.
They were pricing based on expected behavioral outcomes.
Outcomes that the competitors could not even measure. Capital One had identified a prime borrower trapped inside a subprime statistical bucket.
And that leads directly to the most counterintuitive element of their entire strategy. The foundational assumption in traditional finance, the absolute bedrock of lending since the Renaissance, is always a direct, linear trade-off between volume and risk. If you want higher acceptance rates on your loan offers, you must lower your underwriting standards, which invariably and unavoidably leads to higher credit losses. You either lend safely to a few, or you lend riskily to the masses.
That trade-off is exactly what Capital One broke, which brings us to Gear 3, the absolute holy grail of modern consumer finance. Better, more precise pricing yields higher acceptance rates and lower default losses simultaneously.
Which sounds impossible.
It sounds impossible. But because Capital One was not structurally solving for immediate, short-term yield, but rather for expected lifetime economic value, they could present a precisely targeted offer that was significantly more attractive to the specific consumer. They might offer a lower rate or a higher line of credit or a waived fee. Because the offer was objectively better than the legacy bank's monolithic offer, it generated a dramatically higher conversion rate. The consumer eagerly accepted.
But with lower defaults.
Yes, concurrently, because the advanced model had already selected for underlying behavioral reliability and expected profitability within that highly specific microsegment, the actual default rates for that cohort were significantly lower than the industry average for that demographic profile. Lower default rates combined with higher response rates is a structural anomaly in consumer lending. It defies the standard gravity of risk. Capital One captured that anomaly through sheer mathematical precision. They mapped the expected value of every single consumer interaction.
And the massive surplus capital generated from capturing that mathematical anomaly fueled the most aggressive, sustained expansion tactic in the history of the credit card industry. They did not return all those profits to shareholders. They weaponized them.
That is Gear 4. The superior economics immediately funded an absolute explosion in testing volume. As profitability compounded geometrically, Capital One poured those resources straight back into the postal system. By the mid-2000s, Capital One was mailing roughly 1.2 billion pieces of direct mail in a single calendar year.
1.2 billion? I mean, that number is almost hard to comprehend.
I want the physical reality of that data point to land with absolute clarity. 1.2 billion pieces of mail. They were single-handedly keeping regional post offices in business. But that volume was not merely a massive marketing budget. It was not just an advertising blitz. It was model training executed at an industrial scale.
Machine learning via the U.S. Postal Service.
Precisely. Capital One was executing machine learning years before consumer finance had even developed a vocabulary for it. Think about the direct mail envelope as a sonar ping into the dark ocean of consumer credit. Every single envelope that was thrown unopened into the trash was a vital, measured data point about price resistance and offer elasticity. Every accepted offer became a continuous, multi-year behavioral stream. They were constantly pinging the market to map the exact contours of consumer demand.
Which feeds the final mechanism of the loop. Gathering the data is step 1, feeding it back into the underwriting engine is step 2.
Gear 5 completes the architecture. The behavioral data generated from those 1.2 billion sonar pings flows directly and automatically back into the system to strengthen the foundational predictive models. Once a cohort of customers is actively on the books, Capital One continually observes every single interaction.
Tracking everything from payment timing to merchant categories.
They track the exact timing of their monthly payments. They track the specific merchant categories of their daily spending. They track the migration of their balances across different cards. They track their precise behavior when a promotional teaser rate expires. Do they pay off the balance? Do they transfer it again? Or do they simply accept the higher permanent rate?
And utilization percentage.
They track the utilization percentage of their total credit line. They track their risk of attrition to a competitor. That incredibly rich, multi-dimensional post-acquisition data directly improves the models for future underwriting, for dynamic repricing, for targeted credit line increases, and for highly customized retention strategies. The loop is entirely closed and continuously reinforcing.
A perpetual machine.
Let us review the physics of the flywheel. More tests lead directly to finer segmentation. Finer segmentation leads directly to more precise, individualized pricing. Precise pricing, mathematically, yields higher consumer acceptance and lower default losses. The resulting massive profit from that spread funds an even greater testing volume. That volume generates richer, more complex behavioral data. That data builds smarter, more predictive models. And those models start the entire cycle over again with even greater precision and scale.
It is structurally beautiful, I will admit.
That is the invincible flywheel. And the most provocative, industry-shaking claim to emerge from this business model is this: subprime was never a real intrinsic category of human behavior. It was simply a massive, industry-wide pricing error waiting to be systematically corrected.
Oh, I have to stop you there.
Let me finish the thought. By identifying highly profitable, reliable microsegments buried deep inside vast pools of consumers that incumbent banks deemed entirely toxic, Capital One lived and thrived in the massive gap of misclassification. They proved at an industrial scale that bad credit was very often just bad measurement.
I genuinely do not buy that framing. I must express profound incredulity at the assertion that subprime was merely a pricing error. That is a dangerous, almost hubristic oversimplification of macroeconomic realities.
How so?
The data prove they were profitable. It is incredibly easy, almost dangerously seductive, to call subprime a mere pricing error during a prolonged, decade-long macroeconomic expansion. When unemployment is low and GDP is growing, every statistical model looks like absolute genius. But does a sophisticated underwriting algorithm actually eliminate the underlying socioeconomic reality of default risk?
It prices for it, does it? Or does it merely slice that inherent structural risk into such impossibly thin, precisely calculated mathematical tranches that the bank feels completely immune right up until the exact moment a systemic economic shock hits? You can measure the behavioral exhaust of a low-income borrower with perfect, down-to-the-penny precision. You can track their payment velocity, you can track their grocery spending, but perfect measurement does not magically generate household liquidity when a recession hits and unemployment spikes to 10%.
Well, obviously macro shocks affect all lending, but a probability distribution cannot pay a mortgage. Capital One absolutely found highly profitable, mispriced pockets within the subprime space. They did this by charging specific fees and customized rates that mathematically compensated for the higher baseline probability of default, and by utilizing rigorous behavioral data to avoid the absolute worst, most toxic risks within that tranche. That is exceptional, world-class underwriting. I do not deny that.
But you don't think it eliminated the category?
Absolutely not. It absolutely does not eradicate the existence of subprime as a fundamental socioeconomic credit category. The underlying structural risk was still there. It was simply perfectly priced for a perfectly stable economic environment, which leads directly to the inevitable structural vulnerability of their entire enterprise.
You mean imitation?
A superior statistical algorithm, managing a larger database, and executing a higher volume of direct mail tests. What happens when the rest of the world wakes up? What happens when the legacy giants buy the exact same computing power, hire the exact same statisticians from the exact same universities, and learn the exact same mathematics?
The durability of an analytical edge is the central question for any data-driven enterprise.
By the late 1990s and the early 2000s, the legacy giants finally shook off their institutional lethargy. The consulting firms that originally spawned Fairbank and Morris had spent a decade spreading the gospel of information-based strategy to every other bank in the country. Institutions like JP Morgan, Citibank, and Bank of America entirely stopped relying on the intuition of their senior credit officers.
They finally started looking at the data.
They stopped banking with their tummies. They deployed massive amounts of capital to build their own vast multi-petabyte data warehouses. The analytics provided by third parties, most notably FICO, became vastly more sophisticated and deeply embedded across the entire consumer finance complex. Off-the-shelf scorecards began to mimic the proprietary models Capital One had built from scratch.
The playing field started to level.
Risk-based pricing, highly granular direct mail analytics, dynamic credit line management, and sophisticated retention modeling transitioned rapidly from heretical innovations to standard baseline industry practices. The entire industry learned statistics, and the resulting statistical squeeze on Capital One was immediate, measurable, and brutal.
The response rates definitely dropped.
This specific data point here is startling and undeniable. Capital One's direct mail response rate plummeted from roughly 1.4% in 1995 to around 0.3% by 2004. Think about the mathematical implications of that drop for their customer acquisition cost.
It quintupled.
Exactly. If your response rate drops from 1.4 to 0.3, you have to mail almost 5 times as many envelopes just to acquire a single customer. The cost of acquisition skyrockets. The competitive environment became intensely crowded, vastly more expensive, and entirely unforgiving. Every consumer was receiving 5 offers a week from 5 different scientifically optimized banks.
But that wasn't the end of them.
No, but Capital One did not suffer a massive regulatory blow. They did not face sudden technological obsolescence. The wall they slammed into was pure, unadulterated imitation. The magic trick was publicly revealed, the math became a commodity, and the proprietary advantage evaporated.
I am fundamentally not convinced by that line of reasoning, because you are dangerously conflating the compression of a margin with the total collapse of an advantage. I absolutely refuse to concede that their edge was entirely lost simply because the initial massive mathematical asymmetry narrowed.
How is going from 1.4 to 0.3 not a collapse of the advantage?
Capital One hit a wall of cultural diffusion, yes. The math became democratized, but they retained a profoundly powerful compounding structural advantage. By the time the legacy banks finally managed to install the requisite software, build the data warehouses, and purchase the external credit models, Capital One had already institutionalized continuous testing as a deeply embedded operating system for over a decade.
You're arguing for a cultural moat.
Absolutely. They possessed a depth of managerial muscle, institutional memory, and recruiting infrastructure that simply could not be bought off the shelf by a legacy bank. You can buy a database server on a Tuesday, but you cannot buy a corporate culture that fundamentally trusts a statistical output over a vice president's ego. That takes a generation to build.
So how did that culture save the unit economics?
Capital One survived the intense statistical squeeze in standard consumer credit by seamlessly migrating their mature mathematical models into adjacent, highly complex financial segments that the legacy banks were still pricing by habit. They moved aggressively into auto lending. Auto lending is vastly more complex than credit cards because you have to model the depreciation of the collateral, the car itself, alongside the behavioral risk of the borrower, while managing a sprawling network of independent dealerships.
And small business.
Exactly. They moved into small business finance, another notoriously difficult segment to model precisely. Their advantage evolved. It transitioned from an insurmountable proprietary algorithmic edge into a deeply embedded cultural survival mechanism. The specific risk pricing software was commoditized, but the corporate culture that rapidly generated new models could not be replicated by simply hiring consultants.
That is a very compelling structural argument regarding their survival. I agree that the company survived, successfully diversified, and remains a highly profitable, dominant institution today. But have you considered that the fundamental nature of the competitive advantage permanently changed?
In what way?
The asymmetry. The period where they were essentially playing a different sport than their competitors vanished entirely. Once every major player in the financial market thinks scientifically, models probabilistically, and tests rigorously, you are no longer playing an entirely different game. You are simply playing the exact same game with slightly more experienced players.
But experience matters in that game.
Sure, but the extraordinary lucrative spread between Capital One's internal predictive models and the industry standard baseline models fundamentally compressed. They went from possessing a proprietary, highly detailed map of the financial universe to merely having a slight head start on the exact same highway as everyone else. The era of the pioneer ended and the era of the incumbent operator began.
And that evolution from pioneer to operator is exactly what makes their history so vital for understanding modern business dynamics. The transition from an insurmountable algorithmic edge to a deeply embedded cultural survival mechanism is actually the definitive blueprint for how modern technology companies disrupt legacy markets. The mathematical edge buys you the time, the capital, and the market share to build the culture. And the culture is what sustains you when the mathematical edge inevitably diffuses across the industry.
If we are extracting the core transferable lesson from the Capital One history, we really must connect it to the pattern recognizers of the modern era. We see direct, undeniable parallels in companies that execute this exact same playbook across entirely different verticals today.
Like who?
Consider Progressive in the auto insurance market. They surveyed a mature, saturated insurance market and realized it was being priced entirely too crudely, based on simple demographic proxies like age, gender, and zip code. A 25-year-old male was charged a high premium simply for being a 25-year-old male.
Very similar to the old banking buckets.
Exactly. Progressive built superior measurement tools. They deployed telematics, physically putting dongles in cars, and later using smartphone sensors to analyze the actual behavioral noise that incumbents ignored. They measured hard braking, late-night driving, and acceleration patterns. They successfully entered risk segments that the legacy insurance were absolutely terrified of, precisely because Progressive can measure actual driving behavior rather than relying on blunt demographic categories.
Stripe is another great example of this in the payments space.
Absolutely. Or look at embedded finance. When Stripe decides to offer a merchant cash advance, they completely bypass traditional commercial credit scoring. They do not look at a standard business credit file. They use active, real-time transaction flow. They analyze API error rates, refund velocity, shopping cart abandonment, and daily revenue consistency. They find highly profitable internet businesses that legacy banks find entirely too messy, ephemeral, or complicated to underwrite.
And it extends beyond finance, too.
Right, look completely outside of finance at a company like Netflix. Netflix fundamentally turned continuous viewer behavior, pause rates, completion rates, search queries, into billion-dollar content commissioning decisions, much like Capital One turned continuous borrower behavior into credit product design. It is the exact same architectural playbook applied to different data exhaust.
Those are excellent, highly precise parallels that perfectly illustrate the mechanic.
Because it is part of a much longer historical continuum of informational advantage. If you go back to the 19th century, the Rothschilds utilized the fastest proprietary network of carrier pigeons and couriers to acquire political and financial news before anyone else. They converted that sheer speed into relationship dominance and financial arbitrage before the telegraph eventually democratized speed.
Then Bloomberg in the 20th century.
Yes. Bloomberg built the richest, most comprehensive financial terminal. They aggregated disparate market data, and they converted that raw data edge into total workflow lock-in on Wall Street before financial data itself became a widely available commodity. Capital One built the smartest, highest volume testing engine, and they converted early statistical model superiority into a durable, unassailable data science culture before the rest of the banking sector learned basic statistics.
The pattern just repeats.
The pattern is remarkably consistent across centuries. You find an informational asymmetry, you exploit it to build structural power, and you rely on the resulting cultural or workflow moat when the information itself inevitably commoditizes.
Given that consistent historical pattern, we can isolate 5 highly portable, concrete lessons from the Capital One story that apply directly to any builder, founder, or analyst in any industry today. First, the most profitable massive industries in the world are very often still run by sheer habit and operational inertia. The absolute easiest place to build a staggering information edge is in a market where massive daily data exhaust naturally exists, but is entirely ignored in favor of operational convention.
Because convention is safe.
Right. Second,
Testing cannot merely be a marketing tactic executed by a siloed department. It must be the core operating system of the entire enterprise. It must dictate capital allocation, and it must structurally overrule executive hierarchy. Third, better, more granular measurement actually creates entirely new markets that incumbents firmly believe do not exist. It reveals highly profitable customers hidden invisibly inside seemingly toxic bad categories.
Assuming the macro environment holds up.
Fair point. Fourth, temporary mathematical edges will compound geometrically, creating massive competitive moats if you industrialize them early enough and aggressively enough. And fifth, as we have established, the corporate culture is the only thing that actually remains after the mathematical model inevitably gets copied by the market. Which leads me to a critical, forward-looking question for you regarding the current landscape.
I'm listening.
If Capital One's foundational edge compressed primarily because of the basic statistical diffusion of risk-based pricing and off-the-shelf data warehousing, what happens right now in the era of AI-first underwriting and embedded finance? Will modern cloud-native lenders utilizing artificial intelligence and non-traditional data streams compress Capital One in the exact same way that Capital One compressed Signet's legacy competitors 30 years ago?
I believe a second-generation compression is already aggressively underway, and it is reshaping the entire landscape. The underlying architecture of Advantage is shifting once again. Artificial intelligence, specifically deep learning models, combined with vast platform economics, allow modern fintechs to train their risk models on incredibly broad, unstructured, non-traditional data sets that a traditional bank cannot even parse.
They can iterate almost instantly.
They can iterate exponentially faster and at a fraction of the computational and financial cost of traditional direct mail or legacy data warehousing. Capital One utilized the physical direct mail envelope in the U.S. Postal Service as their primary laboratory for behavioral measurement. Today's embedded finance players use the entire global digital ecosystem as their laboratory. Capital One disrupted the industry by being the absolute first to perfectly measure the historical exhaust of credit. They looked at what you did last month.
And the new generation?
The next generation of AI lenders is measuring real-time, instantaneous digital behavior before the credit is even explicitly requested. We are converging on a profound, almost unavoidable realization about the core mechanics of capitalism. When superior measurement capabilities enter a market long before the incumbent culture is structurally or psychologically prepared for it, the pioneer looks like an absolute magician.
Because they are doing things that seem impossible.
They perform operational feats of underwriting and pricing that appear to completely defy the established laws of financial physics. But eventually, inevitably, the magic simply becomes infrastructure. The extraordinary statistical breakthrough simply becomes the baseline price of admission.
We have thoroughly unpacked the core mechanics of how a simple, direct mail envelope systematically dismantled decades of entrenched banking conventions. We have seen precisely how 80,000 controlled experiments a year transformed a credit card from a blunt, monolithic lending instrument into a highly configurable, constantly adapting information product.
And we have rigorously traced the historical reality that an analytical edge is ultimately a burning fuse. It is brilliant, it is undeniably powerful, and it generates massive initial enterprise value, but is fundamentally destined by the laws of competition to force the rest of the market to evolve and adopt the very mathematics that once threatened them.
We must honor the profound complexity of this historical transition. While the algorithmic gap undeniably closed, the cultural architecture that Capital One built remains one of the great, enduring case studies of corporate reinvention in modern history. We leave it to the listener to carefully evaluate the current landscape, to look at the AI models being deployed today, and to decide if pure data science remains a defensible, long-term competitive moat in finance, or if it has simply become the necessary, commoditized foundation to even sit at the table. This is the Research Desk officially signing off.